Oh no, it's blurry off the bat. Don't even know what to say about that. We'll see if it fixes. Who knows? We are going to have a blurry intro. Welcome to the weekly Sunday stream. This is ridiculous. We didn't even get halfway through the stream before the camera got blurry. One of these days, I'm going to figure out if I can just slowly. It's focused just way too close right now. Hopefully, it fixes. There's no point in me being full screen right now when the camera's blurry, so I'll just be blurry in the corner. But as you can see, we had a very good week last week. We took home a total of $2,119 after commissions. Luke in the YouTube chat, congratulations on cracking the seal. What's going on? Thanks for tuning in. Excuse me. We had a really solid week. And what we always want to emphasize is the fact that we were able to do this on a week when the market was red. Now, the market was red because if we take a look at the S&P 500, and what happened, we will see that at the very end of the day on Friday, there was this massive, massive, massive sell-off. It looked like it was going to be another week where, even though during the week, if this loads as I speak, come on. This is annoying. Nothing's working the way it's supposed to tonight. Here we go. If we go to the 5-day chart, boom. It seemed like it was going to be one of those weeks where this is Monday, and off the bat it was green, and we thought we were on our way to another green week. And then by Tuesday, Wednesday, Thursday, we finally got that big red day that we were looking for, and that helped us bring in some profits on a lot of the bearish positions that we were holding and had been holding week over week as we attempted to make some profit on those, patiently waiting for the market to come back down, and it finally happened. But then, after it dipped Thursday morning at about 11:30 a.m., the second we hit the afternoon, it ripped right back upwards and didn't quite get back green again. But Friday, another huge rip upwards, and I thought it was going to be one of those weeks where, we were so patiently waiting for it to be red, and then you blink and all of a sudden it's 1.5% higher. However, at the end of the day, it fell kind of back off the face of the earth, which was a relatively severe drop when compared to how much it had moved up, but kind of got back down to where the lows were, and still not quite down to Thursday's lows. But all in all, point being, is the market S&P 500. There we go. Well, it was down 1.06%, and NASDAQ was down 0.89%. Can we get this to focus back? I'm going to stop worrying about it. But it was down, and we made money. So we get that question a lot, right? We talk about how we just got to July. We just got to the second half of the year, and we got to a point where we're having objectively a decent year, right? We're up about 12.5%. We're about halfway through the year. We're on pace for a little bit over 20%. And we've had a very, very conservative approach to the market so far this year. Excuse me. And naturally, we do get that question, if the market's running up, it's very easy to make money. And that's correct. But with our strategy, what we're doing is we're kind of playing both sides. In fact, some of these bigger weeks that we had right here, you can see our blue line right here, our dips, were because the market ran up. So just because the market has run up doesn't mean that we're benefiting from that. We're benefiting from our strategy because I think we have a sound strategy, and we kind of play both sides of the coin. With that said, we don't have a ton for next week lined up already, so we're probably going to have a little bit of discussion about what the economic calendar looks like for next week, what we're looking at from an RSI perspective on some of the bigger stocks out there, and just some general research about what might be a good game plan going into Monday. But before we get into that, let's talk about our week, how we made a couple $1,000 in the red market, and why we ended up with, a really, really great start to July, right? June was a little rockier for us, and it's always great when we could look back in a month and say, we had a rocky month and we made money. We ran into a lot of it. Hey, there we go. It focused. But we ran into a bunch of issues in June with, some things that weren't necessarily mistakes, but I think just kind of a tough streak of luck. With the market running up as much as it did, and we like to scale back in to have it reverse. But we finally had something go our way beginning of July, and we're off to the races again. And we haven't made more than $3,000 in a month since March, so we are well on our way to doing that this month. And hopefully, that'll be the goal, somewhere 3-4K for the month, and just steadily keep building. Right? We don't need to hit a home run. We don't need to do it all in one week, but it's also very important to remember that we could undo all of it very, very quickly. But with that said, last week, we had RCL. We made $472 off of it. That was one that we were playing with the RSI thesis, right? We talk about this a lot, where if you go to the 1-year chart, you're going to see a situation where it ran up and up and up and up. And if you zoom out to the 3-year chart, you'll say, okay, you're maybe running back into a little bit of resistance here. Now we did run into that resistance and we saw it fall back down a little bit, but there was this massive green candle to kind of break through that, and that's what put us in a little bit of a tough position with RCL. But start to finish with RCL, right? We started playing this thing down when it was at like 93-ish. And again, we started out with the 93-95 call credit spread. So really we started playing it down in the low 90s. So we started around here, had a bearish position, had these three massive red candles against us. But because of how we managed the position, we started off with a loss of 291. We then lost 150 more to lose 441. And then we got crushed a little bit last week to lose 1,600, and then we finally made back 472. So all in all, it's a loss, but it's one of those situations where we don't want to get too risky, triple, quadruple down. Sometimes just limiting the magnitude of a loss is just as good as a gain. So yes, we had a tough stretch of luck where we had a really, really big green candle against us, but we mitigated that a bit. And then looking backwards over the last few weeks, of course, we're profitable overall. So we have plenty of winning trades to balance out the losing trades. Of course, the biggest thing with the strategy is to make sure that the magnitude of those losing trades is small enough so that you don't get crushed when those occur, because they will happen. You will lose money. It's only a matter of time. Wayfair was another one where it ran up decently against us, but another great example of how when you give yourself a little bit of flexibility, have a little bit of patience, what you'll see. And for whatever reason, the charts are doing a terrible job loading tonight on Thinkorswim. Here we go. We go to the 1 year chart. Well, we'll see. Boom. We've got this really, really big run up that we were looking at. If we look at the chart like this is kind of what we previously were looking at. We saw it get into the red in RSI. We saw it was approaching a previous high. And then when we have that intersection of, previous high RSI, usually a decent indicator that something's going to come back down. But of course, whenever you go into some sort of bearish position, especially on a stock like this where it ramped up so quickly, you always want to remember that it could always go a little bit higher. We're not going to nail the top every time, and that's what happened here with this green candle. Put us into a little bit of a loss last week, but we were able to get a decent bit of that back when we finally, boom, got these two big red candles, got that move we were looking for. Now, we were set up at 66 strikes, so we could have made a little bit more cash, but in going with the lower strike, it plays back to the idea of, things could always get much worse. We don't want to take on more risk than we need to. And we're perfectly happy between these two positions, making back $922 and continuing on. Faux Life in the YouTube chat. What's going on, man? Thanks for dropping a message. UAL, this is one that was a little bit annoying, and I think we could have done a slightly better job by taking a strike higher. And what I mean by that is, yes, this one has moved against us. And you'll see, again, that big green candle that we've been trying to manage for a lot of these. But this one, we at least got a red candle in our favor at one point, but still it remained elevated from the low 50s when we entered into that bearish position. What's good about UAL, though, if we take a look, yes, we lost $4 on it last week. But the way we managed it 2 weeks ago, it was an overall gain of $324 on a bearish position, despite the fact, again, that we started this short, bearish, whatever you want to call it, position in the low 50s, and it kept pushing against us. So good management there. The one thing that I think we could have done better is when we did roll it, we'll go to the 10-day to illustrate this, because we had this big red day. We finally got what we wanted, and then this was the Friday expiry where it popped back up, 54.50-ish, 54 and change. And we rolled our strike in the money. We kept it at 54. And I liked that idea because this thing was really, really overbought. But after we got this big red candle down, RSI went back down below 70, and at that point, it was still slightly overbought, but not, supremely overbought to the point where RSI was above 70, and it's one of those home run bearish type setups. So I think that's the biggest mistake we made, was keeping a strike at 54, saying, I think it's going to keep coming back down, as opposed to just rolling the strike up. And I don't remember exactly what we could have gotten, but I think it was somewhere in the neighborhood of 60-ish cents. We would have had an opportunity to close that for a few $100s of profit at one point last week. So yes, we did lose $4. And one thing that I think we did do well here, because I think the selection of the strike was a mistake, but one thing that I think we did well was on Friday, right? Sometimes when you've got these trades that are a little bit in the money, and you'll see Friday is right here. Our strike was 54 down here, so we knew that it was above our strike. And typically when you got something like a 54 strike, it's expiry day, it's trading at 54.50, 54.60, 54.70, etc. There isn't going to be a lot of extrinsic value on that. So effectively, when you don't have a lot of extrinsic value, what you have at that point is just a short position, right? Because there's no benefit of waiting between, that time we have right there and expiry, because what's going to burn between then and expiry? Extrinsic value. If there's no extrinsic value, there's no benefit in holding, and you might as well just have a short position. So to me, that's a little bit risky, because what happens if the stock runs back up, like to where it was on Wednesday, late morning, early afternoon? And that's exactly what happened. So we were able to get out overall for a net debit of 98 cents, get out for a $4 loss. If we had held on to this thing, it would have been worth about $1.50. So we'd have lost 200 more bucks on that one. So I think we did a bad job picking our strike off the bat, but we made up for it, understanding the amount of extrinsic value left in our position and just playing it safe and getting out. Sometimes, especially when you get to Wednesday, Thursday, Friday of a week, you've got a decent idea where your positions are going to end up. So we were looking at a week that was a little bit over $2,000 of profit, and I feel our biggest goal at that point is just to make sure we actually get there, right? Whether you're looking at that profit tracker and you see that $2,000 profit number on Thursday afternoon or Friday morning, evaluate your portfolio. Which positions do you think you can rely on to go to expiry? Which positions, if they moved against you, could really hurt you? You may have one like United Airlines, like we had, where if it moved in our favor, it could have helped us a little bit. But our goal was to kind of get that good green number that we were looking at. So we just exited the position, because if it moved against us, it could have taken us down below $2,000 of profit. And that's how that played out. So I think that one was well managed, even though it was poorly entered into, if that makes sense. Next one we got on the list is PANW. Another RSI discussion. These were a lot of bearish trades because the market was overbought, and kind of still was overbought as of Friday afternoon before that big red candle on the S&P 500. And there we go, super slow for whatever reason. So we go to the 10-day chart. We'll see Palo Alto Networks was running up. Bigger picture, 1-year chart. What do we see? We see that plus 70 RSI. The line turned red. So we figured that was as good of a time, there we go, as any, to enter into a bearish position. And we did 2 weeks ago, and it lost. So we had a 255, 260 credit spread. And unfortunately from that chart, you could see, if we go back to the 10-day chart, it got above 250. And really annoyingly, this is expiry day right here. It didn't do it until expiry day. And it got up to like 256. And at that point, we're like, all right, look, expiry day, just like what we talked about with UAL. We've got what we've got. There's little extrinsic value when it's in the money on expiry day, and we know that it could get worse, so we got out of that position. But we didn't quite get out of it. We rolled it, and instead of keeping a call credit spread, which you could have done if you wanted to reduce your risk, we took a position where we were down 35 bucks on the spread, and we rolled that 255 short leg that was part of that call credit spread, and we rolled that up and out to 257.50. So the great part about this trade, and what I love so much about how we handled it, is one, it moved against us. This sucks. It's objectively higher than it was when we entered into it. The trade moved against us. Yet we had a trade that 2 weeks ago we started out seeking a $112 max profit with that spread, right? The $1.12 credit would have given us $112 at max profit. We lost 35 off the bat, but by rolling it up and out to this and getting a larger credit, we made 281 last week. So if you net that 281 against the $35 loss, we have $246 of profit. So that trade that moved against us, and we only set out for $112 of max profit, by managing, moving higher, and taking advantage of those RSI driven opportunities, we ended up with twice as much as the original max profit that we set out for. So that's a great example of how these spreads can be a little bit flexible. And again, you didn't have to roll this up to a naked call. You could have rolled this out to another spread, and so long as you beat $35 of profit, meaning better than a 35-cent credit, which you would have done at that strike, you would have also been a winner on this one. So that was a good one. Here's a bullish trade. The first four were bearish. This one and Disney were bullish trades that we added to the portfolio to balance things out a little bit. Then you'll notice, even though the market was red, our bullish trade hit max profit. Now, why do we think that is? We go to WBA. It's going to be a very similar discussion, right? We go to the 1-year chart. We see that the stock was not quite below 30 from an RSI perspective, but really, really close to it. Profitable stock, one that I wouldn't have been, too upset about owning. And there you go, back to that 10-day chart, bounced right off that level that we were sitting at, and we made max profit on that trade of 108 bucks. Disney was the next one on the list. it was looking really, 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 really good for a while, and then at the last second on Friday, it wasn't. So we currently have been assigned 100 shares of Disney. So we sold these 89 strike calls, and we sold them for what, like, yeah, 71 cents. So our break-even price last week on Disney was 88.29, which is all the way down here. And again, still a decent place to be, in my opinion. And we did not make max profit because the big red candle at the end of the day took it down below that. And if we go to the 1 day chart, you're going to see that big slide at the end of the day. At about 1 o'clock, I totally thought this was going to hit max profit. So it went to the back of my mind, wasn't even worried about it. But at the end of the day, look, we have ended up with shares that we could dump pre-market and just say, hey, we're going to bag $35 of profit. Or we could continue the position, right? Because we know that our break-even price is 88.29. We've been assigned the shares. And if we go next week and want to sell calls, what we could do right here is say, hey, we've got a break. Sorry, I'm bringing my calculator up. We've got that 88.29 break-even price. We could sell an 89 strike call for about 86 cents. And all of a sudden, we still have that small half-size position with an 87.43 break-even price, which is all the way down here. Way down here. So that is what we've done with that. And I think that's probably what I'm going to do. Just going to sell a covered call on it. Get that break-even price down here. Now, when you zoom out to the 10-day, it doesn't look as great. But again, extend that to the left. Stock hasn't been down there in the last 10 days. So I think even though we've got a full week in the market, we had a nice short holiday week last week. Still a decent place for us to be right here. No issues there. Now, UCAR is the only other one. This finished 3 cents below 650 on Friday. So should be a gain overall, but I'm going to dump these shares Monday morning. We're going to get rid of these. I don't want to keep playing. It's going to be roughly in that 646, 647-ish area, and that should be like a net zero right there. So that's the plan for those two, because those are going to be on the bottom of our profit tracker, just in case you were wondering about those. And then moving down here, SQQQ, right? We knew that maybe a month or two ago we had a little bit of a disaster with SQQQ because it got oversold, which it does sometimes. And typically when it gets oversold, it bounces back up. But again, typically, not always. And those are the things we want to keep in the back of our head, because if we really, really, really leaned into that, when this thing initially got oversold up here, we would have gotten slammed. We did lose around $1,500, $2,000, I think, on it. But again, we made all of that back this past week. So again, keep those losses small. The gains will eventually push through. But again, it got to a situation where it was a little bit oversold again. So we go back, we follow the rules. It didn't work last time, but it didn't work not because we had a dumb trade. I think we set it up smartly. It just didn't work, which is going to happen. So we go right back to it, and we made 120 bucks. Of course, that's not going to make back what we lost on it, but enough of these smart trades over time should compound to get us to a place where we want to be. And that now takes us to what I think is probably my favorite trade that we entered into last week, and it's worth a little bit of discussion with DWAC. You'll notice we had one entry where we got in, got out, $150 of profit, and then we had a second entry at a lower strike where we got in, got out, and got 170 more. So we made $320 through 2 trades on DWAC, which I think are really, really low risk, and I'm going to tell you exactly why. So if we go to DWAC, you're going to see a really, really volatile stock. It's been all over the place. We go to the 3-year chart, it shot way up, all the way back down, but what you'll notice is it never goes below 10. And why is that? For those of you that follow along the Discord server where we've talked about this, you're probably like, HT, I already know, but we're still going to talk about it. And that's because DWAC is a SPAC, SPAC. It's a special purpose acquisition company. And effectively, it's just a company full of cash. Now, there's this, not rumor, but I think they're relatively deep into discussions about taking Truth Social public, which once that happens, do not touch this. That thing is probably going to go to zero. But until that happens, this is still just a company full of cash. So it can't go below 10. And the great part is, let's say you're a little bit more risk averse and say, look, I'm worried that somehow a merger gets pushed through tomorrow and it goes below 10 and I don't want to get screwed over. Well, what you can do, because the likelihood that this goes below 10 is so low, in fact, you could do what we did where we go out to August 18th expiry and we just buy the 10 strike puts for 1 cent, right? Remember, we got 32 cents of premium just off the puts we sold for last week, the short week the like 2 day till expiry trade, we got 32 cents a premium for that. These 10 strike puts about 4-ish weeks out, more than 4 weeks. It's like five to 6 weeks out. These are only 1 cent. So if you are worried and don't trust that it'll stay above 10, because it will, you could just buy these puts. And that's exactly what we did, just in case we're wrong. Like, I'm 99% sure that I'm right that this is going to be above 10 come August 18th. But if I'm wrong, I'm protected at a very, very cheap price. It's the cheapest insurance you'll probably ever buy for what we're making on this. And now the great part about this is we got in, and then when we got a nice move in our favor, we got out. And the very next morning, it fell right back down. And what do? We get right back in, because we know that we're going to be able to collect some decent premium week to week. And these puts that we have that expire in August, these are going to protect us for the next 40 days. So we could run this over and over and over and over. And the great part about this is due to the behavior of the stock. And what I mean by behavior of the stock is how it shoots up sometimes, right? We saw on, July 3rd that it flew way up from 1251 to 15.7. That pumps some implied volatility into this thing. So what it does is it pumps premium into these calls. So if we were ever assigned on these puts, the great part about this is, looking at next week, for example, I guess this Friday, there's a decent-ish bit of premium. It's definitely died off a little bit. It's not as high as it once was. But again, we're protected down to 10 for the next 6-ish weeks. So if we start with something like a 13.5 strike put again for next week, and we sell that for what, like 30-ish cents, that's a 13.2 break-even price. And let's say we get assigned. Oh well, so what? One thing we can do is sell covered calls on that for either at the money for like 30 cents or out of the money for 20-ish cents. And then all of a sudden you're knocking this thing down 25 cents a week. So week 2, week 3, week 4, week 5, week 6. Now that's not going to get you all the way back down to 10, but that's just assuming that it goes all the way back down to 10. You'll lose a little bit of cash in that situation, but 11.95, over the past 180 days is below the low. So I think it's a decent way to try to keep pulling a little bit of premium out of these positions. We've got Steve M in the YouTube chat asking about some analysis for AMD call option 115 strike expiring August 2023. Why not? Let's do it. So AMD right now, and with AMC, I was going to say that's not the chart I expected to see. There we go. With tech in general, and it has sold off a little bit since it got really, really, really hot. But you'll see on a 1-year basis, it still feels a little bit elevated. And it's going to trade in sympathy with things like NVIDIA, which is still, once again, running pretty hot. Intel, I think, has come back down a little bit because it never really ran up as much as the others. It's come back down. But AMD is probably a little higher than I would be interested in investing in that. And that's because the multiples, I think, are insane on this thing, right? If we go to Analyze, we go to AMD, and we go to the bottom here, I think what we're going to see, I think this is the, where's the price to earnings ratio? Price to earnings ratio, there we go. Current 449.12. Now, I don't think it's exactly that high, but the point being here is it's very, very high. So the actual value of this company is a little bit tougher to swallow. And the number one rule when selling options, and this may be a question about the idea of purchasing a 115 strike call, but if we're looking at it from an option selling perspective and we wanted to own the stock and we thought the stock was going to do well, one thing we always want to be comfortable with is the valuation of the stock and answering the question, is this something that I would want to own? And the answer to me with the valuation combined with the recent run-up is it's not a stock that I think I'd be comfortable with owning because there's a decent way down. Could it catch fire again and run up if you were thinking about buying the 115 strike call? Absolutely, it could, but to me the downside risk is far more palpable than the upside risk. And if you're looking at buying, what's going to be tough about this is implied volatility. Let's see if I could add this to the chart as well. The issue here is implied volatility. I stand corrected. I thought it was going to be a little bit higher, but it's definitely cooled down since that initial spike and nowhere near as high as it used to be. So it's a little bit lower. But again, the issue, of course, is if you buy a 115 strike call, what you need is one, a move in your favor. Two, you need a move in the correct magnitude in your favor. And three, you need the timing of that move to be just right. And from a logical maybe not logical is not the right word, but in plain English, maybe if you buy a 115 strike call and you're paying 660, 670 of premium for it, you need it to go above 121.60 to make money on that. Now, can it get back above here by August? Absolutely. But to me, decent sized gap on something where I think there's already been a decent bit of excitement. We know AMD is a tech stock. Tech in general, if this can pull up as quickly as I talk about it, tech's still a little bit overbought, and I think it's mid 60s. Where did RSI go? Come back, RSI. There we go. Yeah, so 59.87. I think the sell-off at the end of the day on Friday bumped that down a little bit, but still slightly overbought. Just that sector, chips especially, are a little bit scary from a valuation perspective. So not something that I love for the idea of purchasing. So you're talking about another 40 days out. I think to me, if you're looking at buying an option, which like I always hate, which is why I sell options exclusively. If you want another 40 out, right, the value proposition is still kind of the same, right? You're going to have more premium. Oops, this is QQQ. If you go back to AMD, you go another 40 days out and go into something like, October. That 120 is 855, or 115 rather, is 10, so you have to get to 125, which is, obviously a little bit higher, but you get a little bit more time, but still, you still need that decent magnitude move. And if you don't get it, the thing is going to start losing value pretty quickly. And if this thing shoots back down and all of a sudden AMD drops back to 100, well, this thing would be about $15 out of the money. And what does an option that's $15 out of the money look like? That would be at about 130-ish. That's down to 5. So you lose about half the value on that really, really, really quickly if this gets back down to here, which from a chart perspective looks pretty decent for a retest. I don't try to get too much into the technical analysis part of that, but that's something I probably personally would not be the biggest fan of. So moving down, Affirm, we jumped into this, and I love the idea of these Affirm and these run trades because we entered into these on Thursday. And I think anytime you see a move in the market on Thursday that's really, really big, whether it's up or down, whatever it is, it's an awesome opportunity for entry because there's so many things we could do, whether it's rolling, whether doubling down, to manage these positions where it's really, really tough to lose. Now, don't get me wrong, we can still lose, but it's really, really hard for it to happen. So we saw that happen on Thursday morning with the firm when it went from 14.50 down to 12.81, and we have a firm on our watch list. We're kind of familiar with the price action typically of the stock, so we already knew that it went from 16.53 down to 12.81. That's about a 20-ish% haircut in the price of the stock already over a 2.5-ish day basis. That's a lot, really quickly. So if we go to the 1-year chart, we'd see that RSI isn't 30, but again, the market's still generally overbought. So anytime you see anything on the south side of 50 in an overbought market, sometimes that's about as good as you're going to get. So what we did is we sold these 13 strike puts, and we sold them, I think we did it literally when it was at like 13.50. So we entered here and it still dropped another 70 cents against us. But things go down, they come back up. That's not going to say they're going to go back up and stay up forever. But in the short term, we like to believe the market moves a little bit like this. So we sold these puts, it bounced off at 13, and we made a really, really nice, easy, stress-free $115. We did something very, very similar with Run, Sunrun, ticker RUN. And if you look at the 5-day chart, so similar, right? You've got this stock that had a really big dip. But what we did this time is we sold one that was actually a little bit in the money. So we were kind of playing that bounce in a sense. So we get a decent bit of extrinsic value, and we sold the 16.5 strike put for 37 cents. So our break-even price was going to be 16.13, which is down here. And it did get below at one point. It did get below that. But it bounced back up, and we were able to capture not only the extrinsic value of the option that we sold, but also a little bit of intrinsic value because we sold an option that was in the money. So we're able to make a little bit more than we typically do on those quick in and outs. But thanks to those two quick trades, just because we saw some red in the market on a Thursday, we're able to take home 243 bucks. So a really, really nice situation there. And if a couple of these positions had already reached their conclusion, I probably would have looked around the market and found a few more of these. But again, we don't want to have the portfolio get out of control because, again, the market could always get worse. We've been of the opinion that the market's going to at least take a little bit of a breather or go down for a while now. So the last thing I want to do is be bearish, 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 finally get that move, and then all of a sudden it keeps moving down and we've already switched to bullish and we get crushed, even though our overall thesis was a little bit bearish, if that makes sense. And then two other trades to talk about right here are going to be MDB and Restoration Hardware. Now, these were longer term trades. What you notice about this was we've got an expiry of August 18th and we have an expiry of July 21st. So it's like, okay, these are obviously not the typical weekly trades that we enter into, but why do we like these so much? And the answer is that it gives us time, right? We talked earlier about that AMD option, right? Where you need that move, you need it in your favor, and you need it to be as big of a move to cover the premium. And on top of that, you need that move to happen in a certain time frame. It's a similar idea, even though we get a little bit of a cushion when we're selling options, right? Because yes, we like things when they move in our favor, but sometimes they'll keep moving up, right? Especially with some of these RSI trades, if something's overbought or something's oversold. We do nail the top and the bottom sometimes, but we're not always going to nail the top and the bottom. If we did, I would not have a blank wall behind me. You guys would be looking out a window at like a beach somewhere. So we've got to remember and stay safe in that regard. So what I really like and have started to lean a little bit more into is anytime we see an option, or a stock rather, where it's getting a little bit overbought, instead of maybe going with the weekly trade, what we do is open a little bit wider of a credit spread. And instead of going for that weekly trade, we push it a little bit further out. And we target maybe a little bit more aggressive of a strike than we normally would. But in doing so, we get a little bit more premium. So what you'll notice is typically when we enter into these credit spreads, like if you look at next week, we've got 153, $180-ish of profit potentially lined up. What you'll notice with MDB is that we actually made 275, so that's more than we typically set out for. And even though we opened the August expiry, even though at the beginning of July we said, hey, we're going to give ourselves 6 weeks for this one, the great part about this is sometimes, like I mentioned, we do nail the move. So if you go to the 1-year chart, it ran up, it got overbought, we sold a spread, and what you'll notice is it fell right back down. Now, it did push against us a little bit further, and we're like, okay, it's running against us, but we're fine because we're protected by the spread and the amount of time until August. But we finally got that move we looked for it. And it wasn't even this continuation of the move on Friday, but this first initial red candle that we had on Thursday morning, that gave us all the opportunity we needed. So just from that red candle, we were able to collect about a fourth of the overall value on this trade, which is 275 bucks. And the great part about this, we're still over a month away from that August 18th expiry. Just because you put these spreads a little bit further out from an expiry perspective, it gives you decent flexibility, and you have the opportunity to just say, hey, 275 bucks in a week, that looks great to me. And why do we think that looks good? And the answer is because max profit on this trade is $1,130 over the next 6 or 7 weeks. So if we have max profit of $1,130 over like a 6.5-ish week period, that's $173 per week. Now, if we're in a situation where we could get $100 more than that, $275 in 1 week, we're exceeding the linear gains to get to max profit. So we're a little bit ahead in the race. So we take the money. And we did the same thing with Restoration Hardware, ticker RH. This 340, 360 strike. Now we used a little closer term expiry because the option premium looked pretty decent, and I felt a couple weeks was decent. And if you go to RH, what you'll see, very, very similar thing happened here. It's been running up, running up, running up, running up. But on a 1-year basis, this RSI was really, really hot, right? It got over 80, and that's typically a great place to get in at. And it's not just the overbought RSI that we like to take a peek at when we're making these bearish trades, but we also want some sort of other idea of like resistance that we're potentially running into. And this red line that we have right here, this is why we love, I don't love all technical analysis, but I think support and resistance is important because the history of the chart sometimes gives you a decent indicator about the future. So when this thing's running up, running up, running up, running up, running up, what you'll notice is there aren't really any crazy peaks that it runs through. But when we get here to this, 330-ish level, we have this big peak back in August of 2022. We have another peak that was 350-ish, which, scared me a little bit, but that's why we go with the 340, 360 because it makes our break even 340 plus the credit we received. So basically 344.65, which is close enough to right here. It's this red line right here is our break even price. And again, sometimes we're right. And we got that red candle Thursday morning. And the great part about this, we saw when we looked at MDB that the red candles continued, and we probably could have made a little bit more money had we held. But the great part about taking profits is you're out and you're good to go. So we took a profit on that big red candle. We took 50% basically. We took 180 bucks of profit on that one. And the great part is that Thursday afternoon, Friday, it went back up. So what did we do? This trade isn't over. What we did is we got right back in. So we initially opened this for 465. We got out for 265, which is going to make us 180. And then we got back in for 445. So it's not quite the 465 that we started out with. But the great part about these longer dated spreads, you get out, it moves back up, you get right back in because if it's moving back up and you've got a bearish thesis, probably decent entry to go back in on it. So even though our max profit that we set out for was 465, this thing hangs below 340 and for another couple of weeks, we're going to make 180 plus another 445 for $625 of profit just because we're able to say, hey, we got the move we wanted, we got out. And now there's never going to be that guarantee that it's going to go back up and you're going to be able to get back in. So even if it kept going down and we say, oh no, we could have made more, sitting there and complaining that you could have made more money is one of the best complaints to have in the market because it means that you did make money. So I would love to sit here and say, oh, we could have made more money, because this is what your profit's going to be looking like. So that was the idea with MDB and Restoration Hardware, and that's why you're going to see Restoration Hardware in one of our, our longer term holdings, and it's kind of the only one in there right now. But like the idea of using some spreads like that, giving yourself a little bit more time to sit back and wait, treat it, use that analogy of the farm. You plant the seeds, sometimes you'll come back and things are growing a little bit quicker than expected, so you harvest them and you're good to go. And you can go back and plant those seeds again if the situation dictates as such. But that was our week last week, $2,119 of profit. Really, really solid way to start off the second half of the year. Made a return of slightly over 1% when the market went down over 1%. And that's always fantastic from a outperformance perspective because, again, this is our big goal. If we can't outperform the S&P 500 and NASDAQ on a long-term basis, what are we doing here? I could be doing something else with my time because if we couldn't accomplish this, there's no point in doing this. But luckily, we have accomplished that. We're lagging a little bit this year, but our idea has been to be a little bit more conservative and to just have more of an income generation approach. Because in 2022, and we've seen historically, there have been some really, really big ups and downs. And sometimes the stress is honestly not worth it when between the ups and downs, you get where you probably would have been if you just took the slow route up. So it's not the most exciting thing all the time. But I'll tell you what, if we could have our profit curve look like this blue line every single year, year in and year out, we will be one of the best investors of all time. And even though we're underperforming a little bit this year, we remember what we talked about on the top of the stream. And we can look at what happened last week as proof. We're not reliant upon the direction of the market in a given, or I guess overall, right? Typically, we like to be bullish because the closest thing to a guarantee in the market is that in the long run, it's going to go up. But on a week-to-week basis, there's no need to be bullish every single week. We just take what the market gives us and we keep the line moving. So speaking of keeping the line moving, let's talk about what we've got set up for next week. And what we'll notice, for starters, is we've got a very, very small portfolio set up for next week. And why is that? Answer one is because some of the larger positions that we had hit max profit last week. RCL, W, UAL, we just got out of there. Palo Alto Networks, WBA, SQQQ. Those expired worthless. We're good to go. We don't really need to touch those again. So there's no need to go and just because you have a successful week, jump back in. This is another really, really important point that I want to drive home. It can be really, really easy to fall into the trap of saying, hey, we made $2,000. Let's just go blindly it's not even that late yet. Stumbling over my words. But let's go blindly fill up the portfolio with trades that'll get us back to $2,000. You don't need to do that. And of course, what we always want to be aware of and be cognizant of is these new trades during the week, because just because you have X amount of trades in your portfolio when the market closes on Friday and opens on Monday morning, you don't have to stick with that, right? You can move in, you could move out, you could add things, you could take things out. And 5 days in the market, as we have seen and experienced, is a very, very, very long time. And in fact, futures right now down about 0.2%. So maybe there could be another red move in the market that could help us out and give us some more opportunities to slowly scale back into some bullish trades. But main thing we want to underline here is those new trades, quote unquote. We made $1,128 of profit from those last week. So those are not insignificant. Half of our money last week was from new trades that we were not currently in. And in fact, since the market had such a short week, right? It was half day on Monday, closed on Tuesday. We didn't even have a 5-day week and we were able to add this much to our portfolio. So great place to be is like this. You're not going to get crushed in a small portfolio. It's fine if you are set up to make 0.25%. You could work your way up to 0.5 or 1%. You'll get to that point. But getting back to the main point, because I love to just go on tangents while you guys just listen to me. The market in a little bit of no man's land right now, which is not the worst thing in the world, but it's really something we want to be cognizant of. And from a TA perspective, not to drown you out with TA, but we had what looks like a little bit of a double top. We're falling back down. Futures are back down again. And RSI is still a little bit elevated. Again, that little dip on Friday took it back down below 60. So it's relatively more neutral, but still we haven't had a decent breather in the market. Now, we had this nice slide from mid-June. And this was a 1-week slide, but it got eaten up very, very quickly. And of course, when you look at it, on a shorter term basis, you might say, oh, this is a pretty big dip. But of course, you go back on, from a 1-year perspective, this is not quite a dip. These are dips. These are dips. These are dips. It's typically stairs up in the market and elevator down. So the red can happen quickly and it could get you very, very fast. So we want to be prepared in case it does happen. So we have plenty of cash on the sideline to react to that. And that's exactly what we have set up for Monday morning. Now, there are a few positions that we entered into, and let's talk about those. When we can't find anything, we like to isolate those scans. We go to the high ROR puts without earnings, right? We like to look at some stock-based results. It's probably going to take a second. But yeah, when we look at RSI, what do we see? We see some stocks that are a little bit oversold, meaning anything below 30 to me, decent entry for a bullish position. So we see Humana, we see SunPower. You'll see that these are two bullish trades that we have in our portfolio. And if those things hit max profit for us, that's going to be $320. Not too bad. What we notice about SPWR is it's showing only 10-ish bucks of profit right now, which is because we took a similar approach to what we talked about earlier with Sunrun, where we sold one that was slightly in the money with the idea that, hey, if we start with the half position, we sell something slightly in the money, we're perfectly flexible to scale in. And if it goes below 9, we'll add 5 more. And we'll do so probably at a lower strike. But the great part about this is we sold some 9.5 strike puts, as you could see. And if we add more, we do the quick break-even calc. But our break-even will be below $9 a share. Which in the context of the last 20 days, being below 9 is not too bad of a place for us to be. So I'm happy with that one. Humana, a little bit bigger of a stock, right? The last time we traded a stock naked in the 400-ish level was with NVIDIA a few weeks back, and that one definitely took a couple years off of my life. Not that it ever got too bad. Less, I don't want to deal, maybe it's probably bad luck that I don't know the ticker, HUM. But I don't want to deal with taking assignment or anything like that quite yet. So what we do, we just start off with a spread. Now, again, 1-year chart. This looks like a really, really decent place to own the stock, in my opinion. You go to live news, you take a look at some of these price targets, 540, not 2,900, but 530, 637, all significantly higher than here. So at the end of the day, if shit hits the fan, so to speak, and we have to take assignment of this is not a bad place to own this thing at. But just to protect ourselves in the meantime, in case Humana goes down to like 400, instead of losing, $2,000, we'll only lose $400 and potentially stay a little bit safer. Anytime you're wary of the market, spreads like this are a great way to protect your downside risk. because Humana literally could go to zero tomorrow, and if we sold a cash secured put, I would be in shambles. But if we have this spread, obviously it's not going to go to zero, but point being, the most we can lose, again, $400. Keep those losses low. Doing a spread, great way to do that. And then Disney, these are the 100 shares that we are assigned, that we received over the weekend. And then UCAR, we also get assigned. Now we're going to dump these. We're going to keep Disney, sell covered calls on those. We can anticipate that we'll get, somewhere in the neighborhood of, 70-ish cents, I think is what we said. So if you add that to the pile, there we go. We've got 518 of base profit for next week. So, point being, nothing terribly exciting. But when we look at this, when we look at the S&P 500 RSI, we don't see anything terribly exciting. We're kind of in no man's land. Nothing's running too hot. Nothing's running too cold. There's only 3 stocks that are below 30 RSI. There are a lot that are above it. And in fact, there's 2 right here, RIVN and LUV. Duh, I didn't even talk about these 2. But Rivian, really, really bad company. Can't emphasize that enough. And you'll see these big spikes on bad companies. That happens a lot. Implied volatility through the roof on this one. So we could start ripping back up. But what did we talk about earlier when we were looking at something like when we were looking at Restoration Hardware? Look to the left on the chart. There's this really, really, really big gap back down. But where does this gap stop? This gap stops at roughly 27.52. So what do? We take that information and we sell a 27.30 call credit spread. With the 27 short leg on the call and a 51-cent credit on that, what's our break-even price? 27.51. Literally a cent off of this line that we just drew. So that's how we approach that. Yes, it'd be great to be a little bit more aggressive and go to 25, but of course, like we talked about earlier, we're not going to nail every single one of these. But all we know about this thing is what we could see historically on the 1-year chart. And we could see RSI is red hot, 84.96 on the 1-year. You very, very rarely see that. So there we go. Sell 3 of them. And look, if Rivian goes crazy and goes to like 100, oh, I didn't put the max on there, but the most it could be worth is $3. So the most we could lose is $750. So point being, from what we're holding, very, very difficult for us to have any sort of a disaster. So what you want to do, and I think the smart approach when we have these decent sized weeks, is to say, hey, let's not push it. If the market gives us the opportunity to push it, yeah, we'll push it. But in a vacuum, I don't want to do anything too crazy here. I don't want to rock the boat. Let's just try to focus on getting another green number to build on the last one, because we know even with all the volatility, right? We had this nice stretch from March rather to mid-May. We were making on average $937 a week. We had a little bit more volatility here. And while we had some much bigger weeks, like a $2,000 a week, a $4,000 a week, the average here was $483, half of that. So even just a little bit of red in the middle of all this can derail those average weekly profits very, very significantly. It crushes your average returns. So focus number 1, keeping this number green. Because again, even during this stretch from March to May, can't emphasize this enough, where we averaged $937 a week. We had a few where we made $306, $174, $142, $358, and we still averaged almost $1,000. Even though when we have the more eye-popping weeks, that average is significantly less. So keeping the week's green is so, so, so important. The big focus this year is no steps backwards. Starting with a low quantity, majority defined risk portfolio is a great way for us to approach that, I think. Now, there are some other things where if the market is down and a little bit red, we've got this scan ready to go. We've got all sorts of names at the bottom of this where RSI is low that we could potentially take a bite out of. And again, just because something's on this list doesn't necessarily mean that it's a good investment. However, it's definitely worth taking a peek at because these are offering decent premiums. And theoretically, when you look at their charts, you could look at something like STNE. They're all going to kind of look like this, where they're falling down and look like a decent potential entry. And this one's kind of running into some of these previously established levels of support and resistance. Could be an interesting one to look at, but hang tight. 5 days in the market is a long time, but this is what we've got. Only thing that I want to mention here is Southwest Airlines. Delta reports earnings on Thursday. So ideally, I'm out of this spread before those earnings are reported. And that is all I have to say about that one. But in the meantime, we are going to be taking things day by day. Earnings are starting to kick back up, but still nothing significant. I think we've got CPI coming out on Wednesday. Nothing too wild from a news perspective this week. So with that said, that's about all we've got. Appreciate you guys tuning in. Really awesome week last week to kick off the beginning of July. Now, we don't really have any fireworks, so to speak, set up in the account this week, but the nice flip side of that is we also don't carry a considerable amount of risk. So with our first full week in a while, it's going to be really, really nice to have 5 days in the market, be reminded of how long 5 days is, and I would not hate just another nice, boring week. Because remember, we've got this Restoration Hardware call credit spread that still lasts for the next couple weeks. We've got some SWVXX, that money market fund that we've had our cash sitting in. Some of that's going to be coming in next week as well, I believe. So just stay patient. Money should be coming in nicely in the account that we're tracking. And of course, like we mentioned last week, we had over $1,000 in new trades. So trades that were opened during the week or new to the portfolio that we weren't holding at the top of the week. So definitely going to have our eyes out for something like that. In the meantime, just stay careful, stay patient, make sure you have plenty of cash on the sidelines, because cash on the sidelines equals flexibility. And in maybe a more uncertain market, a market that looked a little bit shaky at the end of the day on Friday, a market where seasonally you hear that saying, sell in May, go away, where summers typically feature some sell-offs that we haven't quite seen yet. Having cash on the sideline and defined risk trades are how you're going to be able to navigate that environment. But that's about all we've got to say for tonight. So without further ado, thanks for tuning in. This has been Hourglass Trader, where as time passes, we make money, and hopefully we will talk to you guys again same time next week with more money in our account than we have right now. And we made good on that promise last week, finally, after a little bit of volatility. But hopefully we could stack another good week, 2 weeks in a row, and get back to just making some money week after week after week. But again, on a monthly basis, we've made money every single month this year. So it's always great when we look backwards and say, hey, we had some struggles, we had some rough luck, we had some things move against us, yet still on a monthly basis, we made money. But that is some perspective to close out the stream, and that is all I've got for tonight. So with all you tuned in, really appreciate it. We'll be in the Discord server all week. Hourglass-trader.com has got all the links for all the tools, HD Premium, you name it, you can go check it out. And I will stop rambling and let you guys get back to your Sunday nights. Thanks for tuning in. We'll see you guys again.